Is Home Depot at a great price to buy? The stock has been on a nice uptrend for the past 3 years or so and has since dipped. And after hours at the time of this recording, we can see that today was not the best day for Home Depot. They're down about 8% on the day, which equates to about $30 per share. And this is a result of their Q4 2021 earnings release, which we're going to get into now. So the question really remains. Is it a great time to buy shares of Home Depot as they've just dipped? We know the age old saying, buy low, sell high. So is this the buy low opportunity for Home Depot? They currently have a PE ratio of 21, which equates to about a 5% expected return on the stock long term. And they currently have a market cap of $362 billion, which we'll use for our valuation later on. So is Home Depot a value buy right now? Is it too expensive? Is it cheap? What's going on with Home Depot? That's what we're going to find out in this video. So stick around. We're going to talk about that and more on today's video. How's it going? Welcome to Everything Investing. I hope you're having a great day. With that being said, let's jump into Home Depot's Q4 2021 earnings analysis. So again, looking at this from a macro point of view, we can see Home Depot has been in a clear uptrend really for quite some time now. If we take a look, we can scroll back. I mean, this has been a long-term compounder. And as you can see here, after today's report, we're kind of on this little island. So the question is, where are we going to head from here? We've just broken through a bunch of key levels and we look like we're heading lower. So the next key level that I'll be looking for in terms of support to hold this stock up would be this price range here, where it currently is heading into right now. So that would be all the way down to around $300 per share. If it begins to fall lower than that, I'll be looking at, this 260 price range for some support in and around this area. And this would be a great buying opportunity for shares of Home Depot. As we've seen, it's been a great compounder. That being said, I haven't taken a look at the financials yet. So we can't say that just yet, because if the financials have changed, if the fundamentals have altered in any way, this may no longer be that same compounder in the future. But assuming this is just a typical market overreaction, this might be a great opportunity to pick up shares in and around these key levels. So with that being said, let's get into the earnings highlights. So we can see right away their revenues did beat by about $870 million. Actually, year over year, this is about a 14% increase in terms of their revenue figure. Now looking at their earnings per share, this beat by only 3 cents. I mean, it's pretty much what analysts had expected. And in terms of the year over year earnings per share, this actually increased 30%. So from a company like Home Depot, right away we're seeing some great growth numbers, but that has to make you wonder, why is the stock down so much today? And that's something we'll get into in just a second when we go through the financials. But before then, we wanted to make an honorable mention that they did just get approval from the board to increase their quarterly dividend to $1.90 per share. This is actually a 15% increase. And they've had actually another record year. And they're guiding towards a slow but positive sales growth for fiscal year 2022. Now, with that being said, if you wanted to get in on this dividend increase, you need to get in by March 10th. March 10th is the record date. It's the last date to get shares of Home Depot if you want to take part in that 15% increase in their dividend. With that being said, now that we've seen the earnings highlights, let's jump into the actual financials for Home Depot. All right, starting with their statement of income, we can see they have net sales of $151 billion for the fiscal year. This is, again, that 14% increase. Their cost of sales also increased about 15%. This is how we get to this $50 billion, $50.8 billion in gross profits. We deduct our expenses and we get to this $23 billion figure, which is our operating income. Again, this has increased actually 26% year over year, which so far is a nice check mark. We deduct our other interest expenses and whatnot, and we get to our net earnings figure, which is $16.4 billion worth. Again, almost 30% increase year over year. So it's very good growth, especially for an older and matured business like Home Depot. Now, in terms of their balance sheet, let's go through their current assets. They have cash and cash equivalents. This is actually down year over year, which means to me that they've made either some form of acquisition or they're paying down some of their debt. They're doing something with their cash, and that's what intrigues me immediately. I want to know what that is. They have receivables, merchandise inventories. Of course, they are going to need inventories to run their business. So we have current assets of $29 billion. The next thing I see here is their goodwill, which remained relatively flat. So that means they didn't make a $5 billion purchase or acquisition of another business. So now, again, I'm intrigued. What did they do exactly with that cash? So that leads us to our liability section. And we can see that short-term debt has increased. They now have about $1 billion worth to pay off in short-term debt. If we add this to our current installments of long-term debt, as well as our actual long-term debt figure of $36.6 billion, let's say that figure is about $40 billion worth in debt Compare this to our current assets of $29 billion, and we can see that while this isn't an overarching massive amount of debt, it still isn't serviceable completely by their current cash position, especially since this is only at $2 billion now. They'd have to liquidate a lot of their assets in order to pay it off immediately. However, that being said, they do have total assets of $71.8 billion. So, I mean, yes, the business can afford the debt. Just if they had to do it today, they would struggle just a little bit. So with that being said, that's a small X for me in terms of the balance sheet. I want to see that the cash position is large and growing and also can service their debt whenever they need to. That being said, let's move on to the statement of cash flows. All right, so we bring down our net income figure, add back in depreciation, amortization, all these other non-cash costs, and we're relatively flat in terms of our cash from operations at $16.5 billion. Now, we deduct our capex figure here, and we get to about $14 billion in free cash flow. So what do they do with these $14 billion to reward shareholders? Well, they took on some debt, but they also paid down a little bit of debt. The main thing that they were focused on clearly here was repurchasing shares of stock, which came in at about $14.8 billion worth for the year. Their next main focus was paying a cash dividend. So now we know what they were doing with their cash since they had $14 billion worth in free cash flows. They also took out some cash and some debt in order to pay out the dividend and repurchase all those shares that they did. And that's what Home Depot's current focus is in terms of rewarding shareholders. All right, so now we're looking at our free cash flow calculator. Let's take a look at what Home Depot should be valued at. So if we put in their $14 billion figure in terms of their free cash flows with a required return of 10%, they do pay a dividend. And let's say that they can grow at, conservatively 9% for the next 5 years. And let's say 5% after that with a 20 PE, they should be valued at about $350 billion. If Home Depot can continue the current trend and grow at, let's say, 14% for the next 5 years continuously, and then dip down to, let's say, 9% on a 25 PE, they should be valued at $564 billion. In terms of the worst case scenario, let's use their current PE ratio to indicate the next 5 years of growth, which, if you recall, is equivalent to about a 5% expected return. And let's say that they do only 3% for the 5 years after that. On a 15 PE, they should be worth $235 billion. Now, that being said, earlier in the video, we discussed their market cap. It's sitting at about $360 billion. In the best case scenario, they should be valued at $564 billion. That means you have a massive potential for some upside in a stock like Home Depot from these levels. And actually, as the stock has declined, the margin of safety is actually sitting at about $350 billion per share. If you wanted to be very conservative with this and wait for the absolute margin of safety, it's definitely down at this $235 billion valuation number. But I mean, now is not a bad time to pick up shares, and I'm actually considering picking up shares of Home Depot. I'll need to do a little bit more research on the stock, but the financials and the fundamentals are intriguing me at this current valuation, to say the least. That being said, this is my evaluation of Home Depot. If you've made it this far in the video, thank you for watching, and until next time.